Welcome to Health, Wealth, and Legacy. I'm your host, Sam Abdallah. Our goal is to bring leaders, thought leaders, education to inspire, empower, and motivate you to expand your mindset, grow, and live your best possible life in the areas of health, wealth, financial freedom, and legacy. All right, welcome to the show. So I'm here with Dalia Barsoum. Doesn't need an introduction, but she is and you're going to introduce yourself a little bit more, Dalia, but she's the founder of Streetwise Mortgages, professional best-selling author, Forbes Finance Counsel, and she helps many real estate investors, homeowners. She's a successful real estate investor as well.
I'm passionate about seeing clients grow through real estate, and that's how it all started. Clients coming to us saying, Dalia, I was told, no, I can't get this deal done. Or a bank told me I need to put 30% down. Or a broker told me that I've hit my limit. And we kept them going. We kept them scaling. We kept things moving at the best cost of money. And that's what I love doing and what I love seeing investors do. Because at the end of the day, I mean, despite this market that we're in, and the fact that there is pain on the street because, of the higher interest rates, and real estate is still a fabulous asset class. That doesn't change.
I'd love to dive deeper in what you said there too. You talked about how you have passion to helping people. They were told no. A lot of brokers didn't think outside of the box or understand that. I know you have your financing methodology roadmap. I'd like to dive a little bit about how that helps the average investor or when they're getting started, and why real estate could be still a good asset class today and what you're doing in this market.
The financing roadmap really was born out an idea to combine the concept of planning with mortgage financing. Because when I left the banks in 2011, I was in the wealth management division and I was supporting financial planners, and planning is powerful. You got to plan. Whether or not the plan exactly happens to the T or not, that's beside the point. Without a plan, we're aiming in random directions. So you got to set the target and you got to plan to your best ability and then execute and pivot along the way as things may change. So when I came into the mortgage space as a real estate investor, and I did own properties at the time, I noticed that the process is very transactional. You got a deal, you go to the bank, you go to the broker, the deal gets funded. And nobody was sitting and talking to me about, okay, Dalia, what do you want to achieve through real estate in the next 5 years, in the next 3 years, in the long run? What's your capabilities looking like? What's your risk appetite looking like? Do you have partners? Do you not have partners? How are we going to make this all happen? I was actually craving for such a conversation. And when I became a mortgage broker, I started to take that same thinking of planning from the banks and combine it with the mortgage world to help investors plan multiple properties at a time and then execute one at a time. So the power of that simply is, if you plan your finance ahead of time to say, you know what, okay, I want to buy 5, let's say this year. Where's the money going to come from? How am I going to structure the deal to keep my borrowing power at its best? Is it a corporation? Is it in my personal name? If I am going to use a certain strategy, what's the best money tool? Do I use private money first? Do I use institutional first? Do I use commercial first? Like, all of that is part of this conversation so that you as an investor is clear on how it's going to come together from a money standpoint, and then you execute. And that essentially maximizes your ability to utilize the best type of money at any point in time. Because if you go about it one transaction at a time, it's really limiting your ability to tap into other sources sometimes. And sometimes you may end up limiting yourself too early in the process by going to one lender or by using a certain tool at the wrong time. So that's the whole idea of the financing roadmap. And these are the conversations we have with investors across their journey, whether they're starting out or got 2-3 properties that are looking to get to 10, or now they have a residential and they're looking to go to multifamily. It's the same conversation, very strategic and holistic.
Amazing. So when you said pivoted too, like you're helping people pivot, helping them plan one property at a time, what have you noticed in this market? And I've noticed a couple clients that come to me and either they have renewals coming up and they're scared about real estate investing now a little bit, or they're doing something else. or they're taking another methodology or school of thought saying, okay, let me just start lending my money and make my bank a big HELOC and start lending my money and let me get out of the game for a bit. How have you pivoted your approach in having these conversations, and how does the risk tolerance play into that when it comes to, who you're coaching and what their goals are?
So everyone is different, Sam. But at the end of the day, we want to make our money work for us in real estate. The question is, what strategy do you utilize, and when? And it's a function of obviously your risk tolerance, but also the resources that you have at any point in time. So should you lend your money right now? There is absolutely an opportunity to lend your money because the lending guidelines have tightened and there are great deals out there that you can lend your money against and make a passive return. But the downside of that is that your return is capped. You're just getting your interest, you're getting your lender fee, and then the taxation of it all is very different. But someone may, say, you know what, I am just gonna put a little bit of money here and invest in real estate. And some may say, you know what, I don't want to cap my returns, I'm going to invest in real estate. Regardless of the way you take, you got to get your money working for you. On the investment strategy side of things, a long-term buy and hold is always a good strategy as long as you're carrying your costs. So right now it's a matter of saying, okay, the cost of money is up. Is the property still carrying its expenses? Is it cash flowing? And if the answer is yes, great. Is there something you can do to it to help it carry its expenses, like getting into maybe things that are more cash flow oriented, given the cost of money, rent to owns, co-senior living, maybe student rentals, maybe you're adding a unit. So that's still a great opportunity. But in a market like this, I wouldn't recommend flipping. I wouldn't recommend doing a buy, renovate, refinance and hoping that, the value is going to increase this much and take a big private loan upfront, and absolutely not. So to answer your question, I know it's a long answer, but to answer your question
Really good.
in one statement, should you still invest? Absolutely. Is real estate a great asset? Absolutely. You just got to be selective about what you're putting your money in right now, given your risk appetite, given where the market is, and given the capital that you have.
Amazing. So when a client comes to you, let's say they want to look at their portfolio, they have one property, they have a home property. What's the first thing you do? You sit down with them, they give you some goals about what they like to accomplish. Do you sort of figure out what their situation with their current mortgages now to figure out how to best maximize their portfolio, and then figure out based on their goals, helping them choose a strategy? Or what does that look like in today's market and stress testing the properties? Because you said it has to carry itself almost, right?
Yeah. So right now, what we're seeing is obviously some pain because of the higher interest rates. So when I say pain, I'm referring to higher debt levels in some cases, and cash flow is impacted in some cases. So what we're doing right now with clients is we're saying, okay, let's stabilize your portfolio. Let's make sure that we're addressing any pain points, stabilizing your portfolio, meaning if there are leakage in cash flow, why are we leaking on cash flow? Is it because the interest rate is high on this property? Is there an opportunity to take it to a lower interest? Is there an opportunity to extend amortization? Is there an opportunity to maybe clear some expensive debts for you so we can create some breathing room? So we first want to stabilize the foundation, the current portfolio. And then we want to say, okay, we want to continue to grow because this market is going to present opportunities. So how can we set you up to benefit from that? What does that look like? Do you need to set up any secured line of credits? Do you need to, enhance your balance sheet to create borrowing power? So it's really more of a two-phase conversation. Stabilize right now, and then let's set you up for growth. And part of the stabilization, obviously, is looking at renewals. If you have a renewal coming up, what should you do? Should you take fixed? Should you take variable? Are you okay taking this versus that? That's all part of the conversation, but that's really a big piece today. Closing leaks and stabilizing the foundation to launch into the opportunities that this market will bring.
I love that, because that reminds me of something you said before at the multifamily conference, which is your Well, obstacles become your guidance, but also your hurdles become your stepping stones. I really like that a lot. Can you share with me what you mean by that? Maybe an example of how you've helped someone have their obstacles become now their stepping stones to go back to go forward?
Yeah, I mean, we get investors all the time that say, you know what, I'm stuck. I don't know where to go from here. Or again, I've been told no, and they see it as an obstacle. And then we sit down and say, okay, yeah, right now it is an obstacle, but it's temporary. Here is how we're going to help you move forward, and that's how we start to make forward progress. In the multifamily conference, what I was speaking about as challenges, sometimes when you're in the midst of a challenge, even in this environment right now, people are going, oh my God, you know, if the payments are up, do I sell this property? Do I keep it? I am under a lot of pressure, and the immediate instinct may be, you know what, let me just sell it and dump it and just get rid of this pain. And my philosophy is, it is a challenge. Let's sit down and look at things that you may not have considered, and you're going to learn through that challenge, and that's going to set you up to move forward in better ways and not necessarily act on your immediate instinct to do something just to get rid of that pain. So that's the power of challenges. If you step back and go, okay, I am now facing a challenge, immediate instinct as human beings, we're going to panic, we're going to stress, we're going to get an anxiety, we're going to want to run away. That's our immediate instinct as human beings, right? But if we step away from the problem, ask for help.
Our wealth creation partner, 337. 337 creates wealth for entrepreneurs. They've used financial structuring to 10x families' net worth. Now we show others how to do it. They make rich entrepreneurial families richer. For more information, visit 337.com to learn more.
Breathe and start to become resourceful and creative and working with others to find creative solutions. You will be surprised of what you can come up with and what you're capable of. So that's what I mean by challenging being your stepping stones. You learn through them on multiple fronts, but you have to recognize that and not just panic and run away.
So it seems like you're definitely helping coach your clients seeing the bigger picture because you've seen this before. Now, when it comes to stabilizing, you mentioned that's kind of a two-phase. You stabilize and then you look at growing. If an investor, what are you finding right now with investors? Are they maybe selling some properties that are not performing? And if it doesn't make sense for them to, maybe they have a property that's hurting their ability to borrow, maybe it's costing them, like their ratios are way off. Are you finding that maybe it's okay to kind of regroup and take that next step after? Because I know people are getting into multifamily, but I find right now it's great. And yet I see that some people are just taking advice from everywhere and they're attempting to implement it all rather than have like a one deep approach. What do you think about that?
Okay, so if there is a property that is negative cash flowing in a portfolio right now, what I suggest clients do, first of all, and what we're doing with clients is we're looking at that property initially and we're saying, okay, is there an opportunity to reduce the payments through debt restructuring? Maybe it's not on that property. Maybe at a portfolio level, there is an opportunity to bring payments down so that you're offsetting that leakage. So although it's on the property, first we're going to look at the property. Is there an opportunity to restructure any debt to help the situation? If there isn't, is there an opportunity, on your balance sheet or portfolio level to restructure something to bring the payment overall down so that that leakage is less? If there is, great. And sometimes there isn't an option. So we start to have to think, we have to tell the client, okay, have you talked to your coach or your realtor? Do you know if there is an opportunity to increase or create income anywhere across your portfolio or on this property itself? If there isn't, okay, and you cannot handle the pressure and we have still some runway before rates start to come down, right? Then the last option obviously is selling. And that's where they have to talk to their accountant and see how can they what do they need to plan for to keep the most in their pocket if they sell. So selling is the last resort. We go through these ideas of debt restructure, income opportunities, and sometimes even, is there a partner that can come in to help you deleverage a little bit to reduce the mortgage amount, but buy into your property. So we have these conversations with clients first before we come to a sale. And then the multifamily front, there is a lot of talk about multifamily. Everybody's talking about multifamily, right? It's like everywhere you turn, everybody's talking about multifamily. It's like the next best thing after sliced bread. Here's what I'm seeing, okay? What I'm seeing is a lot of talk about multifamily, and I don't think, the majority of investors really understand what's involved in making a multifamily deal work. There are definitely some, phenomenal investors who know how to turn an asset around and how to increase the value and how to, they know the formula. But the rest are still thinking, oh, why can't I find an apartment building that cash flows from day one? If I go buy this building with a vendor take back and a private mortgage and get 0% financing, okay, there is no conversation about how they're going to pay that money back. Like there are still missing gaps in the investor community, in my view, in terms of understanding how multifamily works. But is it a great opportunity? Absolutely. Is the money available for multifamily right now cheaper than residential? Oh yeah. I mean, CMHC money is in the fives, right? Versus higher rates residential, and amortizations are longer, 35, 40, 45, 50 if you're in the MLI program. So is there an opportunity? Absolutely. But am I seeing everyone, does everyone understand what it really takes to actually make money in multifamily? There is still a gap there, in my view.
I agree with you. There's also a gap in expectation, like a sixplex that's vacant or that's kind of thing. I know you spoke about in your course too, leveling up multifamily. You had someone speak about repositioning the building. Do you have that conversation with your clients as far as, okay, I would like to buy multifamily. What are some opportunities for people in the multifamily space and then repositioning the building? Is there a certain timeline, or you look at, okay, we're going to reposition this many units and turn them over and then refinance and exit out of this program? And just kind of go into that, because maybe some people would like to know what opportunities are in multifamily from someone who's helping investors on the financing front as well. Selling your home during tough times, whether you're downsizing, divorce, or debt, we understand the unique challenges you're facing. Introducing our specialized real estate solution to help you navigate these difficult times with ease. Selling a home can be overwhelming, and yet our experiencer team will guide you through the process, providing personalized strategies to maximize your home's value. Whether you're downsizing, going through a divorce, facing debt, we'll help you sell your home and start anew. Don't let these challenges define your selling experience. Let us turn them into opportunities. Visit our website at affluenceregroup.com to learn more.
So there are flavors of making money in multifamily, right? I mean, in a major market, let's say Toronto, for example, or within 3 hours away from Toronto, what you're going to see is that the unit price is here and the net operating income is probably here. So when you're buying in a major market, you're not going to get the maximum loan amount from a traditional lender, because it's all based on the income of the property, not the value, right?
Right.
I think investors sometimes don't understand that. They're running the math going, oh, generally on commercial financing, I can get 75% loan to value, and here is how it's going to look like. That's not always the case. It depends on the market you're in. And then if you go away from major markets, you're going to get better price per door, and you will get opportunities to either own a turnkey, maybe if you're in a market that is way out, or enhance the net operating income to create cash flow through a repositioning, which is, what's called the renoviction, or, it's basically getting tenants to churn and renovate the unit so that you can charge higher income and turn the building around. Regardless of the flavor, there are 6 money tools available to investors, and that's what the conversation we have with clients. What are you buying? Where are you buying? What are you planning on doing with the asset? Let's now talk about the money tools. Your resources. How much money do you have? Do you have partners? Are you planning on raising money? Okay, here are your resources. Here are your money tools. What's in your toolbox? Private mortgages, promissory notes, which I do not recommend to anybody, traditional mortgages, which are the typical mortgages where you get a 75% loan, bundle mortgages, where you get a loan to buy the property and a loan to renovate the property. That can go up to 100% renovations. Other people's money, that's where, we're talking about GP/LP structures, corporations, with you bringing money into the corporation through shareholders, and then vendor takebacks. So when we sit down with clients, Sam, we look at what are you buying? What are you doing with that asset? Where are you buying? And then where are you from a money standpoint and a qualification standpoint as an experience who's on your team? Here are the tools, and how can we help you now tap into some of these tools, help you structure things to actually acquire what you want to acquire and get to the results that you want to get to. So that's the conversation.
Now, thanks for sharing that. So do you have maybe an example of something that you've worked with an investor in this market that really has worked? It could be in the multifamily space, maybe. Yeah. And I remember when you had Chris on, he talked about there are companies that will reposition or help reposition buildings and get them into, operating the higher income so they can appraise higher. Do you help also on that exit part when it comes to the, how it's going to appraise and look at a what if scenario kind of thing? Does that make sense?
Yeah, so I'll give you flavors of some deals that we've done. A client who's buying a commercial property, it's a school, and they're looking to convert that school into 14 residential units, right?
Okay.
So that is a deal that we're financing by giving them a bundle loan. So basically a loan to acquire the school at 75% of the today's value, and a loan to renovate the school at 75% of the renovations budget. So that includes the soft and the hard costs. And it's an interest-only loan for 18 months. That loan is going to roll into a CMHC loan under the MLI Select program once it's all done. So that's one flavor. Then we have a client who is taking a residential property. They're converting it into a 6 units. Okay. Wow. And today it's residential, it's a house, but they're converting it to a 6 units by building some laneway units and adding units. So obviously it's a sophisticated approach, but again, we're doing the same thing. Because it's a 6 units, we're going to go to CMHC and we're helping them acquire the house and fund the renovation through a CMHC approved lender. So they're getting renovations money. And if there is shortage in any of these projects, what these clients are doing is we're looking at their portfolios and we're saying, okay, is there any equity that we can take out to supplement the shortage? Because, hey, for you as an investor, if you can keep all of the return for yourself, why not? But if there is a shortage, that's where we supplement with private money, or we supplement with other people's money, like joint ventures or limited partners. So these are 2 active deals that we've done, and they work in today's market. Obviously, they're intense in terms of renovations, but in order to make money in a higher interest rate environment, you have to be a little bit more aggressive with your value add, or the units, the income you're generating through that exercise, for the numbers to work in some cases. Not in all cases, but in some cases.
Okay, so that's a lot to unpack. So you've helped people creating more value in the property is either a conversion or a single family home. So they probably spoke to a designer as far as like architecture, figure out if a property can be converted, the realtor, the zoning and all that. And then you have relationships with these lenders that know this kind of product that will say, okay, this is going to be a 6 unit property. It's going to probably, based on the realtor's appraisal, as well as your appraisal value, we're going to give you the renovation loan. We're going to help you with this exit. Is that what I'm understanding properly?
Yes. And we help the client run the numbers too. Like, we help the client validate how much money are they going to get on exit with CMHC. Because what you don't want to happen is that you're buying something, you're putting this much money into turning it around, and then when the time comes to refinance, you're not getting enough out, right? So we want to make sure that stepping into the deal, we are clear on how much money we will likely get out with CMHC when the time comes. How much money are we taking, upfront to renovate or construct? And we want to make sure that these numbers line up. And also, we've connected investors with engineers to help them qualify for the 100 points with CMHC on the energy efficiency front. Because in order to qualify with CMHC for their best program right now, which is MLI, you either have to build or construct with energy efficiency in mind, or keep some units affordable, or create your units with accessibility in mind. So we connect our clients with engineers if they need help in that front. And then from an appraisal standpoint, to your point earlier, we have to check what is it worth today. And upfront, before they waive their conditions, before they firm up the deals, we want to show or know what is the future value likely going to be. So we do an as-complete appraisal upfront. Even if we're taking private money here and that lender doesn't know what a as-complete is going to be, we still advise the client to do it, because you don't want to step into something assuming it's going to be something and then get surprised along the way.
I like that too, because in the real estate world, we look at what buyers are paying for a property, but it's different from an appraisal perspective. They look at the building, the neighborhood, the age of the property, all those things that you mentioned. I think that's really powerful. So what are some mistakes people are making with, whether it's private money? You talked a little bit about promissory notes, but I know you offer a loan that bundles everything in and helps people move through that conversion, adding more value to make sure that it's worth it in this market. What are mistakes that investors are making with private money or just deals in general, and making sure that they can still do well in this market? What are some mistakes you're seeing out there?
I've seen a lot of mistakes with private money, and we're actually launching our private money product in a few weeks from now to address these challenges for both lenders and borrowers. So here are some common issues that I've seen. Exit strategy. When someone takes money to borrow, like when someone borrows money to renovate, or let's say close on a deal, to close quickly, or to bridge, or whatever they're using the private money for. Private money is easy to get. It's not always easy to exit. So this is where investors say, I'm going to refinance, or I'm going to sell the property. Yes, but did you sit down actually with a mortgage broker who has validated the fact that you will be able to refinance given your circumstances, given where the property is? It's one thing to say I'm going to be able to refinance, and so it's another thing to validate that someone will be able to refinance and get 80% at a 30-year end and get enough out to pay that private lender. So that's where I see sometimes private deals go south, because if you as a borrower took private money and nobody helped you validate your exit strategy, you may get stuck. You may scramble at the end, or you may get stuck with higher fees at renewals, or you don't want to be in that situation. Okay, so exit strategy. The other thing is high leverage on private money. I mean, private money, there are offers on the street that are given private money at 100% loan to value. I know some investors think this is free money. I'm getting free money here. I'm getting a loan for 100% of the value. That's awesome. But guys, it is a two-edged sword. High leverage, especially with private money, is very, very risky proposition. So I've seen investors, for example, who took this type of money at the height of the cycle, and they got stuck. They didn't know how to exit this money. They took this money on multiple properties because somebody gave it to them, and nobody validated their exit. Their projects took longer. Their budgets, it cost them more. Then the market took a turn and they couldn't exit. So you have to use it smartly. And you have to validate your exit by working with a broker who knows how to validate exit, not just give you private money. The art is in exiting the deal, not entering the deal. You got to really remember that. So that's from a borrower standpoint. From a lender standpoint, I think some lenders are chasing double-digit returns. They don't understand the risk that they're stepping into. I had investors call me and say, Dalia, I've lent my money at 19%. I said, okay, what type of deal was that? Oh, it's a promissory note. I said, okay, do you understand what that means? Yeah, it's a loan. I'm going to make my double-digit returns. It's riskier than a mortgage, but it's secured against the property. It's not secured against the property the same way a mortgage is secured against the property. People don't understand the worst-case situation. So as a private lender, if you're going to lend in this market or in any market, stop chasing the double-digit returns. Understand the risk of the deal. Ask the broker to give you information about what this deal is all about. Don't accept valuations and appraisals unless it's a third-party report from an appraiser that is approved. You guys have to protect your interest. So I see these things and we educate clients, we share a lot, but I still see some of these mistakes.
I absolutely love that. I think you definitely, like you said, third party looking at that, helping them through the financing part, making sure they're not making these mistakes, having an exit strategy for these type of loans as well. And I like the fact that you deal with these loans as well as bundle them and help them with the strategy. So you have a clear start and exit as well. I know we got a couple minutes left, but should someone look at stabilizing as far as unsecured debt and making sure things are cleaned up? And is it okay for them to go backward to go forward when it comes to getting back in the game? Because there's a lot of great deals out there right now. I know less people are buying, loan amounts are less. There are some great deals out there to be had. What are your thoughts on that when it comes to real estate investing and just the process?
When you say, is it okay for someone to go backward to go forward? Are you talking about challenges investors are having?
I'm thinking like, let's say they need to clear up some unsecured debts. I had, clients that want to invest, but let's say they need to clear up some unsecured debts. Maybe either that maybe involves selling a property or maybe it doesn't, but they need to clear those things up before they restart that. Would you recommend that would be a good thing, or you recommend they just
there is absolutely nothing wrong? Yes, Sam, you know what? This is the time to clean up. This is the time to get granular and look at what's working and what's not working and clean house wherever is needed. I mean, back in 2020 and 2021, it was all about growth, more properties, more properties. Everybody's accumulating more properties because the interest rates are low. And it was like, okay, now growth is important. Opportunities are still coming because the prices are actually lower and there is a window to own assets. Eventually, the demand, the door will, like right now there's pent-up demand. It's all like sitting behind this door. It's pushing. There is no supply. There is interest rate issues and there is panic and fear. But once life goes back to normal, which it will, the demand is gonna go back into the market and the values will start to pick up again. So if you can buy assets right now and the numbers work for you, great. You should make that move. You shouldn't hold back, especially if it's a long-term play. And absolutely, clean house first, because if you're building a castle on a sand, that's not sustainable and it's not going to work. It's not about acquiring more properties. Clean house. There are situations right now where, we have to get rid of certain debts. We have to restructure certain things. We have to make sure you're sleeping at night. Let's get that stabilized and then continue to move forward.
It's amazing. So I love what you had said. I think there's tons of value in there. And that's the reason we always send our clients as well to you. I think you have a lot of value. So in the last minute or a couple minutes here, what would you say the two success methodologies that you live by and investors should look at adopting to really succeed in any market? And I'm going to edit this one part out. I think there's like 3 minutes left, but I'm going to come back on the thing. So sorry if I'll just edit this part out if you're okay with it, but in that environment. But what would you say the 2 or 3 success principles you live by every day, whether it's from an real estate investing or just anything in general that you'd like to share?
There are a few that I live by. One is doing what's right and doing what you need to do regardless of how you feel. So there are days where we all wake up and feel like, oh my God, I am exhausted, or oh my God, especially right now with all of the negative news and there is heaviness right now. Despite that, I believe, we gotta get up, put that foot in front of the other, continue to move forward regardless of how we feel. And that's, in my view, what separates success from anything else, whether it's in investing or whether it's in achieving goals or in personal life. So that is a big one that I live by. And then the other one is about consistency, staying consistent. And there is so much time in the day, Sam, and there are a lot of squirrels running around.
Yeah.
And with social media, there is a lot of things coming at everybody. So you got to pick one thing and stay with it and focus on it and keep pushing it forward and get really, really good at it. That's what really served me in this business of mortgages and specifically serving real estate investors. We didn't reach, the ranks of a top broker Canada-wide or Ontario-wide by coincidence. It's because I believe in consistency and mastering what I chose to master. So mastering something that you care about, that you know is going to get you places, mastering, staying consistent, doing things regardless of how you feel. And then lastly, which is a big one, and I invest heavily in this area, is surrounding myself with the right people. I take my advice from people with gray hair who have lived longer than me, with all my respect to my peers and some amazing individuals out there, and everybody has something to offer. The people who lived longer than me and have seen things that I have not seen will, guide me through some blind spots. And I surround myself, very selective about who I surround myself with, and investing in myself on many fronts. Like I've invested hundreds of thousands in myself, because as human beings or business owners or real estate investors or entrepreneurs, we're only going to grow to the level we personally grow.
I think there's a lot of themes there, right? Consistency, staying the course, there are cycles in every market, every business, everything. And, going deeper on one thing, picking a strategy. I think it's interesting. You can really relate that to everything, life, real estate investing, running your own race, right? Not being compared to others. There was a book about the brain is wired to be distraction. I remember like when you're in a forest, right? And way back in the savannah, it's like you're thinking of these other berries to chase, right? So the brain wants to look at other things to focus on. So it's really interesting that you bring it, stay the course, find the focusing point, and really help those clients and help himself get through these times. What are some things that investors can do right now to get started again? Maybe they're starting a portfolio, they want to grow, they want to scale up from a multifamily. Maybe they want to book that call with you. And can you just go through a little bit of the cash flow recharge event?
Yes. So for anyone who wants to take the next step up, it's important to assess where you are, first of all, right? So talking to our team will help you understand where you are from a money standpoint. And then wherever you're going, whether you want to get into multifamily or focus on a, strategy, you really got to invest the time and skill to learn from the right people. So one of my really great mentors told me at some point, who are you getting your advice from? So got to assess and understand where you are, go learn and get the right advice from the people who are doing what you want to do, and then start to take action. And my team can help you understand your money roadmap, help you design your money roadmap to get there. We are also very well connected in the industry. Like Sam, you're an incredible, not just realtor, but also advisor. And I love that about you, because you advise rather than transact. Yes, at the end of the day, you will help the client transact, but it's coming from a place of advice rather than let's just do a deal here. So we connect people with people to enable the success of the client, and they can always reach out to us at info@streetwisemortgages.com. And then the cash flow recharge event is something I'm putting together because I have been asked to do it. Clients have been reaching out saying, Dalia, cash flow pain. Where do I generate cash flow? What do I do right now? And instead of responding to everybody on a one-on-one basis, I thought, let's bring in some of the best minds in this space to put solutions forward to the market. So the event is happening online this weekend.
Yep.
Cashflowrecharge.ca. And we're bringing solutions on all fronts to address the cash flow pain, talk about the interest rate environment, provide new ideas for generating cash flow, and it's online Canada wide. And yeah, you don't have to be present for the 2 days to learn this. You can register and get access to the recording later. So if you're in that situation, come join us.
That's incredible. We'll make sure we have this out soon so people can be aware of that. Even and we are actually giving away a ticket to people in our world. So we really appreciate. We're grateful for the contribution. So thank you for that. And I do agree with you. You know, when you have a high level of integrity and do what you say you're going to do, and you work from an operative service of without expecting, your clients are better educated. They're going to do more business with you. They're going to trust you more. It's just such a better business to be in rather than a transactional business. So I totally agree with you on that one. And we'll make sure that everybody can reach out to you at the email you provided. And we're happy that you're serving our community. And thanks so much for jumping on today, Dalia.
My pleasure. Thank you very much for the opportunity to contribute and be here today.
Thanks so much. We appreciate it.
Thank you, Sam.
Thanks, Dalia.